IFF and DuPont announcing a very large deal over the weekend for the flavors and fragrances company. It will merge with DuPont's nutrition and biosciences business. Now, the deal values DuPont's business at about $26.2 billion. The combined company will have pro forma 2019 revenue of more than $11 billion, about $2.6 billion in EBITDA. Here with us at Post 9, IFF Chairman and CEO Andreas Fibig and DuPont's Executive Chairman Ed Breen. Gentlemen, thanks to you both. Thank you for being with us. I know you're coming right off the conference call that you just held. And Ed, let me start with you, because on that call you said IFF is the best partner in every respect. You obviously indicated there was a process in which you evaluated a number of potential outcomes for this business. Why was this the best one for your shareholders?
Well, we made the decision based on strategic fit and culture. This creates the global leader across all the ingredient spaces. It's the broadest portfolio by far, and we'll have double the R&D of any other company in the industry. So strategically, we love this. We can really offer our customers full set solutions that nobody else, any competitor, can do. The interesting thing was it was a competitive process. There were 3 people that wanted to merge with the company. And all 3 of the prices were sitting right on top of each other. So thank heavens we didn't have to scratch our head and say, should we take the other one because the price was better. So we got the price we wanted, great strategic fit, and then we thought the cultures of the companies really gelled well. And that's important when you're integrating 2 large companies together, right? Because that's a lot of what makes it work.
So all right around that 18 times current EBITDA, I guess, in terms of valuation metrics that you're looking at. Mr. Fibig, you know, the Frutarom deal is not that far in the past, and it pains shareholders in part because of some things you found there. What confidence can you give them that you're ready to do another large deal and another very large integration?
So what we would say is that, first of all, we have another 12 to 13 months until we close the deal. And the teams are already planning on the integration. It's a very robust plan. We have our experience from our last big integration. And also the N&B team is very experienced here. So I think everything will go very, very well over the next 12 months so that we are really ready at day one. And we certainly took our key lessons out of the Frutarom deal and we'll do it better this time.
So what were the key lessons then?
One of the key lessons is that everything which is cost related was going extremely well. We are over-delivering on the cost synergies, whether it's procurement or footprint or overhead costs. We certainly have to watch the one-times and the sales, that we bring the teams good together, that we make sure that we're not losing out on this one. And here it's very clear that both teams for the next 12 months have to perform on their base and their core business, and that we made this very clear. And I think it's good that the 2 teams have talked already, and we are very confident that we will go into the next year with a good tailwind.
Andreas, good to see you. Good to see you both. Will you need to do an equity offering after the deal is done, or will the free cash flow enable IFF to reduce its debt?
Yeah.
You will have to do an equity offering, without a doubt. Okay, well, that's important because the stock's down 6. I know you've always been quite candid when you were on Mad Money, and you said, look, for Frutarom, looks like we might have to, and people should be ready. Thank you, that's great. And now, Ed, I'm trying to look at the rest of the company. To me, there's some green shoots that I see. We're starting to talk about 5G. I know that that's been very important to the electronics. What's your next move?
Me personally?
No, the company. I know you're personally. I know you and I are both in the in business, and you're filling. I'm not talking about your next move. I'm talking about your move here.
Well, first of all, I'm staying at DuPont as executive chair, and I'm really excited about it. But you know, look, we're actively looking at the portfolio still, and we'll continue to manage that. And it's the best owner mentality for us in the company, as we just demonstrated with this great merger today. But we have a great portfolio with the 3 core divisions that we have now. We have a lot of secular growth areas we really love. You mentioned one of them is 5G. We're big at lightweighting cars. We're big at electrifying cars as they go towards EV. I mean, these are big markets for us as we move forward. So we got great growth prospects. I wouldn't doubt we do some tuck-in acquisitions along the way that fit. We're going to have a great profile from a cash position and a balance sheet position. So we're really going to be in solid shape here moving forward.
Andreas, Ed mentions R&D. It seems like we talk about proteins and flavors all the time, but where is R&D focused right now? Where will it be focused?
Look, what you see is total solutions. We have now a nice play around different categories. And R&D was actually one of the reasons why we said this deal makes a lot of sense from a strategic point of view. We will be leaders in many of these categories, whether it is plant-based proteins, whether it's texturizers, or it is flavors. So we will focus our R&D to bring these programs basically to fruition, and then look how we can combine these categories for total solutions. Let me give you an example. If you look at plant-based burger, which is very popular right now, IFF is delivering the natural color, the flavors, and now we have the plant-based protein, the texturizers. We basically can provide the total solution, and that could go on and on and on. We have more examples here, and that's something which really differentiates us from any other competitor. And as Ed just said, what we did with this move is not replicable by any competitor with one move. They would need more moves to basically rebuild what we have in our hands.
I want to follow up on the cost synergies and revenue synergies. I think you guys are talking about cost synergies of $300 million, but revenue synergies eventually of $400 million.
Yes.
It's not often we see revenue synergies exceed cost synergies. Can you explain where that's coming from?
So the beauty of this deal, it's more of the revenue opportunity going forward because they're complementary. They're not overlapping portfolios. So the plant-based burger example Andreas just gave, DuPont supplies 5 ingredients into either the bun, the cheese, or the burger. IFF supplies 5 different ingredients into that product. So the power of putting a full solution together, as Andreas said, is going to be really powerful, by the way, for our big customers and our regional local food companies, which are growing very rapidly. They don't have that solution capability, so we'll be able to supply it to them. So the revenue synergies are actually really big on this deal. But because the products don't overlap as much, you don't get quite as much on the cost side. But still, 300 is a nice number to get on a business with this type of multiple on it.
Now, Ed, delivering those revenue synergies is going to be dependent on this management team. Your shareholder base is going to own 55% of this company, and you're getting $7.3 billion in cash as well. Why is this the right management team for DuPont shareholders to believe in as this business changes hands in terms of management?
Well, first of all, the cultures are the same with the focus on R&D, the customer solution set. That's where we were driving. That's where they're driving. And so I think just culturally it fits. But you have to remember, N&B is bringing a really solid and seasoned management team with a lot of depth here. And our N&B team, along with all of DuPont with Dow, has been through massive integrations the last 4 years. So we've put a lot into N&B, and you never watched anything go wrong. It was very smooth. Our team knows how to do it. So we'll get the best of our playbook, the best of theirs. We have, as Andreas said, we have 12 to 13 months to plan this, and we'll have it all laid out and documented about how we're going to proceed. So I'm highly confident, and I certainly know we picked the best partner strategically. Okay,
so Andreas, should I feel more confident, because I love that fruit or rum deal initially, and then in your 10K from 2/26/19, you wrote, due to the nature of the transaction and the characteristics of Frutarom, our ability to conduct extensive due diligence was limited, and we may subsequently identify additional obligations, including those that Frutarom assumed in the prior acquisitions. You feel much more confident in this case. Did you have enough time to do the due diligence, or was this too quick?
Absolutely, and what makes a big difference is that we are talking here to a U.S. company, very clear. It's the easiness of doing the deal. And we had multiple interaction with the DuPont N&B management team. And I would like to reiterate what Ed just said. The culture is so similar that there's a real nice click between the teams, and we will start great from day one onwards.
Okay, and Ed, you got $7.3 billion coming in cash. Tax leakage, that go right to you. What will happen with it?
Well, by the way, the beauty of this deal, because it's a reverse Morris trust, it's totally tax efficient to our shareholders, which is great. The $7.3 billion, remember, we have to de-lever the company because it's less EBITDA, and we'll spend about $5 billion doing that, but we'll still have over $2 billion of excess cash.
Ed, quick reflections on a macro. We just got done talking about everything that got done last week regarding trade, and you see confidence inflecting quickly as a result?
Well, it feels like it is. I wouldn't say we see it in the end market yet. I haven't seen anything significant change. By the way, it's not getting worse. I don't see significant pickup yet. But I think with the stimulus that hit, and that was happening about a year ago, 10 months ago, 9 months ago, You get the feeling, and that's globally, that's going to kick in and help things out here. And then a little bit of the trade tension dying down. It just builds CEO confidence to go out and spend on capital. And as I talk to so many of the CEOs, I've been around so long doing it, you just feel a little confidence maybe coming back here, and they start spending again.
And Ed, finally, the multiple you're getting for this business, people seem happy with, at least judging from the analysts and the call and the questions on the call, leaves a multiple on your existing business fairly low. But I'm looking at a 5-year chart of DuPont. I mean, from the beginning of the talk of taking it all apart to where we are now, are you still frustrated? Or are you frustrated with the performance of the stock?
Yeah, I'm not, because we hit this, when we demerged with Dow, we really hit the industrial kind of softness going into last year. Remember, we took $4 billion out between Dow, Corteva, and DuPont of course. So as the revenue starts lifting up again, these things are going to print cash. They're just in a way better position than they were, and they're pure plays in their industries. I feel very good about it. But just to punctuate your point, the multiple right now, I'm not looking at trading today, so I don't know. The multiple on RemainCo DuPont is 8 times EBITDA. Our industry, and I'm picking just the average, trades between 12 and 14 times. So there lies a really neat opportunity.
Andreas was shaking his head, too. It sounds like he might go out and buy that stock also. It's cheap. Gentlemen, thank you. Appreciate you joining us with the news this morning. Andreas Fibig and Ed Breen, of course, as well on today's big deal, or yesterday's big deal.